Right now in Manhattan, the vacancy rate for the most premium office space is, well, it's effectively zero.
Yeah, literally zero,
Hmm.
which is wild.
Zero. And the average rent for those exact spaces just hit an all-time historical high. Welcome to today's deep dive. We are looking at a stack of sources today.
A pretty big stack, actually.
Right, we've got a press release, some supplemental financial tables, and the full unedited earnings call transcript from mid-April 2026 for SL Green Realty.
And for context, they are Manhattan's largest office landlord.
Exactly. Our mission today is to figure out a massive, glaring contradiction for you. Because, I mean, for years, the mainstream headline has been this blaring binary statement, right? The office is dead.
Right. Everybody pictures empty lobbies and, tumbleweeds rolling past deserted water coolers.
Totally. But that narrative categorizes a massive, complex industry into a neat little box of inevitable decline.
Yeah, and when you step out of that headline and look at the actual data coming out of Manhattan right now, that neat little box gets blown wide open.
Because the capital and the contracts are doing something entirely different than what the headlines suggest, which is why we're digging into how SL Green is navigating supply crunches, shifting tenant demands, and, well, the underlying economic engine of New York City itself.
It's a lot to cover.
It is. Okay, let's unpack this, because the numbers from this first quarter are staggering. SL Green just had the single biggest first quarter leasing volume in the entire 28-year history of the company.
It is a massive volume. I mean, we are talking about 51 Manhattan office leases signed in a single quarter.
Wow.
Yeah, totaling nearly 930,000 square feet of space. And the pricing power is really what truly stands out here.
The average starting rent on those leases was, what, $105.12 per square foot?
Right. That is the highest average starting rent for any first quarter they have ever recorded. And on top of that, their mark-to-market rents jumped 16.1% on replacement leases.
I'm going to stop you right there because we promised to keep things clear for everyone listening. Mark-to-market rents jumping 16.1%. Sounds impressive, but what does that actually mean in plain English for a commercial landlord?
Sure. It means when an old tenant moves out and a new tenant moves into that exact same physical space, the new tenant is paying 16.1% more than the old tenant was paying at the very end of their lease.
Oh, wow.
Yeah, the landlord is literally marking the price up to meet the current much hotter market demand.
So in a market everyone says is dying, getting a 16% bump on the exact same real estate is a glaring signal that the underlying supply and demand mechanics are, severely out of balance.
Exactly.
That leads us to the supply side of the equation. Like, why are tenants willing to pay that much more? It's not like the building suddenly grew more square footed.
They're paying it because there is almost nowhere else to go.
Right.
The vacancy rate for what the industry calls trophy buildings, the absolute top-tier premium modern office spaces, is down to a razor-thin 3.4%.
Which is basically nothing.
Functionally, yeah. A 3.4% vacancy rate across a massive city means there is zero usable contiguous space available for a major corporate headquarters. And the kicker is the future pipeline.
The new buildings?
Right. There are exactly zero new office space deliveries anticipated in Midtown Manhattan for the next 3 years.
Wait, nothing is being built in all of Midtown?
Nothing that will finish in the near term. I mean, the recently finished projects, things like the Rolex building or 525th Avenue, those are already in the rearview mirror and fully spoken for.
Ah, okay.
The next major wave of developments projects like SL Green's own 343 Madison or their massive 625 Madison project, they physically cannot be completed and ready for move-in until 2029 or 2030 at the absolute earliest.
Because it takes time.
Right. You cannot just magically summon a 50-story skyscraper. It takes years of zoning, demolition, steel delivery, and construction.
So it's like a VIP nightclub. The club is absolutely packed, there's a line around the block, and the city bouncer just announced that no one is allowed to build another club for 3 whole years.
That's a great way to put it.
So obviously, the cover charge at the existing club is going through the roof. But let me push back here. If this is a VIP club, who are the VIPs actually paying these exorbitant cover charges in a hybrid work world? Everyone supposedly works from their couch 3 days a week now.
What's fascinating here is how the tenants themselves are reacting to this exact realization. They see the same supply data SL Green sees.
So they know there's no space coming.
Exactly. The smart corporate tenants realize that rents for premium spaces are only going one direction. So they are executing early renewals.
Locking it in.
Right, they're locking in space 3 or 4 years before their current leases even expire, just to guarantee they still have a seat in that VIP section when 2028 rolls around.
Makes sense. And if you can't get into the main VIP room, you look for the next best thing, which must push the crowds elsewhere in the city.
Yeah, that is the spillover effect we are seeing. Demand is so intensely high at the very top that it is cascading down and driving up rents in the mid-price point buildings.
It's like where?
Take places like the Gray Bar Building or 1185 Avenue of the Americas. 1185 had a significant amount of vacancy recently. Now, because of this spillover, it's on a path to be fully stabilized this year, with rents climbing into the mid-80s to mid-90s per square foot. The sheer panic for quality is lifting the entire premium ecosystem.
Which shifts our focus from the steel and glass of the buildings to the actual economic engine of the city surrounding them. Because, I mean, the 2025 macroeconomic stats for New York City, frankly, hard to wrap your head around.
They really are.
We're looking at Wall Street securities industry profits hitting a record $65 billion. That beats the old 2009 record.
Massive.
And city tax revenues reached a massive $80 billion. And it's not just finance, right? New York City now boasts 160 unicorn startups, private companies, valued over $1 billion.
Which is huge for the tech sector.
Yeah, that makes it the second largest startup ecosystem in the world behind Silicon Valley. And my absolute favorite stat in the whole report, 1 in 9 college graduates in 2025 moved to New York City.
The talent pool is acting like a gravitational pull. Companies follow the talent, and the talent clearly wants to be in this specific urban environment.
Here's where it gets really interesting. Let's look at the specific names signing these massive leases. Harvey AI just took over 92,000 square feet at One Madison.
Yeah.
And Clay Labs signed a new lease for over 163,000 square feet at 11 Madison. I have to stop and ask, wait, we keep hearing that tech and AI companies are the absolute champions of remote work. They literally build the software tools that let the rest of us work from our living rooms.
That's the irony.
Why on earth are they signing massive physical leases in Manhattan?
Well, if we connect this to the bigger picture, the assumption that tech companies don't want physical space ignores the mechanics of how artificial intelligence is actually developed. Building large language models and proprietary AI isn't something that happens effectively over a sluggish remote video call. It requires intense, in-person collaboration.
Right, you can't really brainstorm laggy algorithms.
Exactly. You need engineers crowded around whiteboards, iterating algorithms in real time. You also have massive hardware and security requirements, secure server rooms, physical data perimeters, dedicated cooling systems that you simply cannot guarantee when your workforce is scattered across thousands of vulnerable home Wi-Fi networks.
So the physical space is actually a functional requirement for the technology itself, not just a nice-to-have corporate perk.
Yeah, and beyond the functional requirement, they are in a ferocious war for top-tier engineering and executive talent. Those 1 in 9 college graduates you mentioned, they don't want to sit in a suburban bedroom staring at a screen all day.
No, they want the city life.
They demand premium, highly collaborative physical spaces in vibrant cities. If an AI startup wants to hire a genius engineer away from a major competitor, offering them a stunning, state-of-the-art office at One Madison Avenue is a massive recruiting weapon.
Okay, that covers the tenant side, but there's a line in the earnings transcript from SL Green's new president and chief investment officer, Harrison Sittimer, about the capital markets.
Yes, the private credit mention.
Yeah, he mentioned a pullback in private credit. How does a pullback in private credit loans help a commercial landlord?
We have to look at how capital has flowed over the last few years. During the recent tech boom, billions of dollars in private credit flowed into software startups. It created a massive valuation bubble.
Lenders just throwing money at software.
Right, throwing money at risky, unproven software cycles, hoping for a quick multiple. Recently, that bubble started to deflate. Private credit pulled back sharply because lenders were getting burned by these inflated software valuations that never generated actual profit.
So the lenders lost their shirts on software and got spooked.
They got spooked by the digital, intangible assets. But those lenders still have billions of dollars sitting in funds that they need to deploy to earn a return for their own investors.
They have to put the money somewhere.
Exactly. Because premium commercial real estate like SL Green's portfolio is a tangible, proven, hard asset with real contractual cash flows. It suddenly looks like an incredibly safe haven. Capital is fleeing the risky tech cycles and running toward physical buildings in proven locations.
I saw that in the report with One Madison Avenue. They secured a $1.65 billion refinancing package at a fixed rate of 5.81%.
Yes, a massive deal.
But there was some intense financial jargon attached to it. The transcript said there were 44 distinct investors, and some tranches were 7 times oversubscribed. For someone not deep in the bond markets, does that just mean there was a frenzy of lenders trying to get in on this single deal?
That is the perfect way to put it. A tranche is just a specific slice of the overall loan. When a slice is 7 times oversubscribed, it means that for every $1 SL Green wanted to borrow, lenders were lining up offering $7.
Oh, wow.
Yeah, they priced that massive refinancing deal during an incredibly turbulent week globally for the markets, yet lenders were basically fighting each other to fund a Manhattan office building. It is a staggering vote of confidence from the capital markets in the physical future of New York.
So they are spending a fortune to lock in these tech tenants and secure these massive loans, but that massive spending spree creates a new problem for the investors holding the stock.
It does.
Let's transition from that top-line revenue to the bottom-line financial chess game management is playing. SL Green is a REIT, a real estate investment trust. For anyone new to that term, it basically means a company that owns or finances income-producing real estate, and structurally, they're usually required to pay out most of their taxable income as dividends to shareholders.
And that structure is why everyday investors traditionally buy REITs. They want that steady, reliable dividend check in the bank every single quarter.
But looking at the report, SL Green reported a net loss of $1.20 per share for the quarter, though their FFO funds from operations, a metric that strips out depreciation to show real estate cash flow, was a positive 84 cents per share.
Right, they reaffirmed their full-year guidance.
But the big glaring talking point is the dividend. They actually reduced it to $2.47 per share annually. Meanwhile, they're selling off assets left and right.
Yep, the disposition plan.
They have a massive $2.5 billion disposition plan. They just sold the residential and retail components of 7-Day for $222.6 million and 690 Madison for $54.5 million. It's like a farmer who decides not to sell his corn at the market today and instead grinds it up to feed his own livestock, knowing the cattle will sell for 10 times the profit next year. But if I'm an investor, I want my corn today. If the leasing is so historic and the demand is so high, why is management defending a dividend cut? Shouldn't the investors be getting paid more right now to reflect this boom?
This raises an important question about the hidden mechanics of being a commercial landlord. Leasing 930,000 square feet of space is not a free endeavor.
Right.
When a landlord signs a massive decade-long lease with a company like Harvey AI, there's a monstrous upfront capital requirement. You don't just hand over the keys to an empty concrete floor and start collecting checks the next day.
Wait, if they're signing leases, shouldn't they be making money? Why does signing a 10-year lease require a massive upfront cost from the landlord?
Because to secure these record-breaking rents, the landlord has to heavily subsidize the construction of that tenant's dream office. It's called a tenant improvement allowance.
Ah.
From the moment the ink dries, the landlord is bleeding cash for 12 to 18 months before a single rent check clears. The report notes that for this quarter, the average tenant improvement allowance was $107.76 per rentable square foot.
So for a 100,000 square foot lease, SL Green is writing a check for over $10 million just to help the tenant build out the space.
Well over $10 million. That money goes toward demolishing old walls, pouring new floors, upgrading HVAC systems to handle those massive AI servers, building out premium cafe spaces, and making the office look like a modern marvel.
That adds up fast.
And on top of that construction cost, they gave an average of nearly 11 months of free rent just to get these tenants to sign the dotted line. So for the entire first year, absolutely no cash is coming in, but tens of millions of dollars are going out the door to fund the build-outs and pay the leasing brokers their massive commissions.
Which explains the farmer analogy. They are artificially suppressing their own stock appeal today via a dividend cut to build an impenetrable monopoly for tomorrow.
They calculate that by cutting the dividend, they are retaining about $50 million in capital right now. They're taking that cash, plus the hundreds of millions from selling off assets like 780 and 690 Madison, and pouring it entirely into funding this aggressive leasing and redevelopment strategy today.
Wow.
They are intentionally enduring a heavy, painful cash burn in 2025, 2026, and 2027.
But the clock is ticking on that payoff. Investors won't wait forever.
The payoff timeline is the entire crux of the strategy. Their calculation is that by 2028, once all these new leases officially commence and those 11-month free rent periods finally burn off, their FAD funds available for distribution, which is the actual cash flow left over after expenses, will massively accelerate.
Okay, so the cash flow explodes in 2028.
Exactly. They're targeting an incredibly aggressive 95% same-store occupancy by the end of 2026, and eventually aiming for 96.7% to 98% across a 31 million square foot portfolio.
98% occupancy across 31 million square feet is essentially zero vacancy. It's unheard of.
It would be historic. But to build that money-printing machine for 2028, they have to starve the dividend yield today to feed the buildings. It's a strategic sacrifice for a massive residual value play.
That covers the buildings and the balance sheet. But let's move into the truly unconventional aspects of this earnings report, because SL Green isn't just an office landlord anymore. We need to talk about Summit, their massive, multi-level glass observation deck at the top of One Vanderbilt.
It represents a fascinating pivot into experiential tourism.
The report noted a slight weather-related dip in Q1 attendance for Summit, but management is predicting an absolute monster of a summer. The reasons why are so uniquely New York.
Oh, yeah?
They are prepping for the FIFA World Cup, with 8 games at MetLife Stadium, bringing in an estimated 1 million people to the region. Then there's the sale of 250 independent celebrations in July, expected to draw 8 to 10 million people to the Arbor.
Just massive crowds.
And on top of that, they are exporting the concept. They are opening a Summit location in Paris in the summer of 2027.
Taking a local tourist attraction and turning it into a global brand.
But on the flip side of that fun tourism boom, there's the gritty reality of city politics. The city of New York is facing a budget gap, with a proposed budget of $127 billion. To close it, the governor and the mayor are throwing their support behind a new pied-à-terre tax. So what does this all mean?
It's an interesting dynamic.
We have an office REIT operating a global tourist attraction and weighing in on local residential taxes. Does a slight dip in elevator rides or a tax on vacant luxury condos actually move the needle for a corporate office landlord?
It moves the needle significantly, but you have to look at the mechanics of both. Let's look at Summit first. Summit is not just a marketing gimmick for the building below it. It is a high-margin, cash-generating engine.
Right.
We just talked about the core office business, dealing with massive upfront capital costs giving tenants over $100 a square foot to build out space. Summit requires almost zero ongoing capital expenditure relative to its revenue.
Because it's already built.
Exactly. You operate the elevators, clean the glass, and collect ticket sales. It is a pure cash flow stream that helps smooth out the operational choppiness of the real estate leasing cycle. If tourism spikes because of the World Cup, that's immediate high-margin cash hitting SL Green's bottom line today while they wait for the office leases to pay off in 2028.
Okay, Summit pays the bills today. But what about the pied-à-terre tax? Why would a commercial landlord actively support a new tax in their city? Usually, big business fights any new tax tooth and nail.
Because it's a defensive maneuver to protect their golden goose. New York City legally has to balance its budget. If the city has a massive budget gap and cannot find new revenue, they usually default to raising corporate taxes or broad commercial property taxes.
Which hurts them.
That directly hurts SL Green, and worse, it hurts the corporate tenants SL Green is trying to attract.
So they point the taxman in a different direction.
The pied-à-terre tax targets high-earning non-residents who own luxury second homes, empty penthouses in the city. Management views it as a surgical tax. It's estimated to raise about $500 million.
Okay.
By supporting a tax that ensures non-residents pay their fair share for city services, SL Green is insulating the business sector. They desperately need the city to be fully funded so the streets remain clean, the subways run efficiently, and the city remains attractive to those young college graduates we talked about.
Right. You need the city to function to attract the talent.
But they need that civic stability funded without burdening the commercial tenants who actually drive the local economy.
That is an incredibly pragmatic, almost 3D chess way of looking at local urban economics. You protect your tenant's bottom line by heavily taxing the empty luxury condos down the street.
It highlights how deeply intertwined a commercial landlord is with the civic health of their city. You cannot separate the building from the neighborhood.
So bring this all together for you listening. The overarching takeaway from diving into these sources is that broad national narratives like the office is dead can completely blind you to massive shifts happening in hyperlocal urban economics. If you just read the headlines, you miss the reality. For SL Green, the equation is actually quite brilliant. A total lack of new construction, plus a booming AI-driven local NYC economy, equals an absolute landlord's market for premium space.
Yes.
Yes, they are making some painful short-term financial moves, cutting the dividend, bleeding cash on tenant improvements, but they are artificially holding themselves back today to build an inescapable monopoly, positioning themselves to reap a massive cash flow harvest by 2028.
The strategy is a masterclass in ignoring the noise and reading the underlying supply mechanics.
But looking at this data leaves you with a slightly chilling thought. SL Green is fine, they own the VIP clubs. But there are hundreds of millions of square feet of B-tier office buildings out there, the dive bars of corporate real estate.
Right.
If the smart money, the massive tech companies, and the top talent are exclusively hoarding the premium spaces, what happens to the rest of the city?
That's the real question. Are we about to see the greatest wave of forced residential conversions and building demolitions in New York history? Or will those older buildings just sit empty, create a tale of two very different cities?